You can do everything right and still feel like you're losing ground. You got the raise, you put in the hours, but the math still doesn't add up. That's because your income and the cost of your life are moving at two different speeds. Today, we're looking at the structure that's actually causing that pressure. Start with what your paycheck is actually worth, not what number is printed on it. Inflation gets described as prices going up, but the simpler way to feel it is this: your dollars are getting weaker every day. If your salary stayed exactly flat for 5 years and prices rose by, say, 20% over that stretch, you didn't keep the same income. You took a 20% pay cut, distributed quietly, one price tag at a time, without anyone ever telling you directly. Most people never experience inflation as a single moment. They experience it as a slow erosion they only notice when they compare what a grocery run used to cost against what it costs now. Now put wage growth next to that. Wages do rise almost every year for almost everyone. The problem is the rate. Across most recent economic cycles, average wage growth has tended to sit close to and at various points behind the rate of inflation, which means a raise can exist on paper while your real inflation-adjusted income stays flat or shrinks. Economists call that gap real wage growth, and when it turns negative, it means you got a raise and got poorer in the same year. That's not a contradiction. That's the actual mechanism behind the feeling of running in place. But even that average understates what's happening, because not all costs rise at the same rate. This is the part that matters most and gets explained least. Housing, healthcare, insurance, and childcare have, in many regions over the past 2 decades, climbed faster than overall inflation and faster than wages. So if your income rose 4% this year, but your rent renewal came in at 9%, the 4% raise didn't offset the increase. It was outpaced by it before you even spent $1 on anything else. Multiply that across a few categories at once, and you get a household where the income side of the ledger is growing in single digits, while the largest expense lines are growing faster, year after year, compounding the gap rather than closing it. But it's not just that things are getting more expensive. It's that while you're paying more for life, you're also producing more value for your boss than ever before, without seeing that value land in your own pocket. There's a second piece of the structure worth naming, because it changes how you read your own paycheck. Since the 1970s, productivity in most developed economies, meaning how much economic output each worker generates, has grown considerably faster than median wages have. Workers have, broadly speaking, been producing more per hour than their pay has reflected back to them. Pause and think about that for a second. You are, on average, more efficient than your parents were at your age, and yet your own ground gained is smaller. That isn't a glitch. It's a multi-decade pattern. That gap is sometimes called the productivity pay gap. And it matters here because it means wage stagnation isn't a recent slump or a personal stall in your career. It's the continuation of something that's been building for 50 years. Income growth quietly pulling away from the value being created in the economy. Your stable job can be performing exactly as designed by the standards employers and markets currently operate under, and still leave you with less real ground gained per year than a similar job would have a generation ago. This is why earning more doesn't automatically resolve the pressure. If your income rises in a year where your largest cost categories rise faster, a raise doesn't close the gap. It just moves the same gap to a higher number. Double your income while housing and healthcare costs in your area are also climbing steeply, and you can end up with the same percentage of your paycheck consumed by fixed costs as before, sometimes more. The lived experience of that is a kind of treading water that gets mistaken for a personal financial issue, when it's actually an economy-wide rebalancing between what labor pays and what the basic cost of living demands. So what do you actually do with a structure like this? The first move is to stop measuring your financial health by the numbers you see on your screen and start measuring it against the real ones. Income relative to your specific cost categories, not income relative to last year's income. A 4% raise next to a 9% rent increase tells you something a 4% raise alone never will. The second move is to identify which of your expense categories are rising fastest. For most households, that's housing, healthcare, and insurance, and treat those as the place where pressure is actually concentrating, rather than assuming the issue is spread evenly across your spending. You can't out-budget a category that's rising faster than your income, no matter how disciplined you are with groceries or subscriptions. Knowing which lines are doing the real damage changes where you spend your attention. The third move is timing awareness. The gap between wages and costs doesn't widen at a constant rate. It grows faster in some cycles and eases in others. Decisions like signing a long lease, taking on a fixed-rate cost, or timing a job change land very differently depending on which part of that cycle you're standing in. Reading the direction of the gap, even roughly, is more useful than reacting to your bank balance in isolation. None of this is a call to panic, and none of it requires a dramatic financial overhaul. It's simply a more accurate map. The pressure of a stable income that still doesn't feel like enough isn't evidence that something is wrong with how you manage money. It's evidence of a decades-long divergence between what work pays and what the cost of living demands. A divergence playing out at scale in every paycheck, including yours. Seeing that clearly doesn't fix it overnight, but it does mean you're finally measuring your situation against the right thing. If this gave you a clearer way to look at your own numbers, that's really the whole point of this channel. So if it helped, a like goes a long way, and subscribing means you won't miss the next one. And if you want to share where your own gap shows up the most, I'll be reading the comments.